At exactly 9:47 a.m. on March 16th, 2013, Maria Constantinou walked into her bank in Nicosia, Cyprus, planning to withdraw €300 to pay her landlord, and when she inserted her card into the ATM, the screen displayed a message she had never seen before, a message that would change her understanding of money and banking and property rights forever. It said that due to emergency measures implemented by the government in coordination with the European Central Bank and the International Monetary Fund, all withdrawals were temporarily suspended, and that accounts exceeding €100,000 would be subject to a one-time levy of up to 60% to recapitalize the banking system. Maria stood there staring at the screen, reading the words over and over because they did not make sense. Because she had not taken out a loan from the bank, she had deposited money with them for safekeeping, and now they were telling her that they were going to take more than half of everything she had saved over 32 years of working as a nurse, not as punishment for anything she had done wrong, but simply because the bank had made bad investments and the government had decided that depositors would pay for those mistakes rather than shareholders or bondholders or the politicians who had failed to regulate the banks properly. And here is what should terrify every person watching this right now. What happened in Cyprus was not an isolated incident or a mistake that has been corrected. It was a test case for a new framework called bail-in that has since been codified into law across the European Union and the United States and dozens of other countries, a framework that explicitly gives banks the legal authority to convert your deposits into bank equity during a financial crisis, which is a technical way of saying they can take your money and give you worthless shares in a failing institution instead. And they can do this without a vote, without warning, without giving you any opportunity to move your money somewhere safer, because the entire point of the bail-in mechanism is that it happens over a weekend when banks are closed and before depositors can react. But before I show you the specific laws that authorize this theft and the exact trigger conditions that will activate the next round of bail-ins and which banks are most at risk and what you can do to protect yourself if anything can be done at all, I need to tell you about something that happened 6 months before Cyprus, something that almost nobody knows about because it was buried in the financial media and never made mainstream news. And this is where the story gets truly disturbing, because it reveals that the freezing of bank accounts is not a desperate last resort, but a deliberate policy choice that has been planned and prepared for years. In September of 2012, the Federal Deposit Insurance Corporation and the Bank of England jointly published a paper titled Resolving Globally Active, Systemically Important Financial Institutions. And if you actually read this 68-page document, which I did, and which I suspect fewer than 1,000 Americans have ever looked at, even though it describes exactly how your bank account will be handled during the next crisis, you will find on page 12 a section explaining that deposits are no longer considered money that the bank is holding for you, but rather unsecured debt that you have loaned to the bank, and in the event of a bank failure, this debt ranks below other creditors, including derivative counterparties and bondholders, which means that when the bank runs out of money, the derivatives get paid first, the bonds get paid second, and your deposits get whatever is left, which in many cases will be nothing at all. And the paper goes on to explain that this bail-in approach is preferable to government bailouts because it does not require taxpayer money and because it happens quickly enough to prevent contagion, though what they mean by preventing contagion is preventing other depositors from learning what is happening and withdrawing their money before they too can be trapped. Now let me show you exactly how this will unfold during the next crisis, and I'm going to walk you through the timeline day by day so you can see how quickly your access to your own money can be eliminated and how little warning you will receive, because understanding the mechanism is essential to having any chance of protecting yourself. The crisis will likely begin on a Thursday or Friday when news breaks that a major bank or several banks have suffered catastrophic losses, maybe from a derivatives blow-up or a sovereign debt default or a cyber attack or a real estate crash, or simply the recognition that years of bad loans have caught up with them, and the stock market will plummet and credit markets will freeze, and by the close of trading on Friday the authorities will know that if banks open on Monday, there will be a run as depositors rush to withdraw their money, which will cause the banks to fail immediately because they do not actually have your money. They have loaned it out or invested it or used it as collateral for other borrowings. and they keep only a tiny fraction on hand to meet normal daily withdrawals. So Friday night after markets close, the Treasury Secretary and the Federal Reserve Chairman and the FDIC Chairman and probably the President will have a conference call where they decide that emergency measures are necessary to prevent systemic collapse, and they will invoke powers under the Dodd-Frank Act and the Federal Deposit Insurance Act and probably declare a bank holiday under the Trading with the Enemy Act, which is a law from 1917 that is still on the books and has been used multiple times to close banks and freeze accounts during emergencies. The announcement will come Sunday evening, carefully timed so that it breaks after the evening news programs, but early enough that financial media can cover it before Asian markets open, and the message will be crafted to sound reassuring even though the content is terrifying. They will say that your deposits are safe and insured, and that this is a temporary measure to ensure orderly resolution of troubled institutions. But what they will not say is that safe and insured does not mean you can access your money, and temporary can mean weeks or months, and orderly. Resolution is bureaucratic language for converting your deposits into equity in banks that are already insolvent. And here is the part that most people do not understand until it is too late. The FDIC insurance that everyone assumes will protect their deposits only covers $250,000 per depositor per bank, and even that coverage is not cash that the FDIC has sitting in a vault ready to pay out. It is just a promise backed by a fund that holds about $120 billion, which sounds like a lot until you realize that total deposits in US banks exceed $18 trillion, which means the insurance fund covers less than 1% of deposits. So if multiple large banks fail simultaneously, which is exactly what happens during systemic crises, the FDIC cannot possibly pay everyone, and the process of filing claims and waiting for payment can take years, during which time you have no access to your money and no way to pay rent or buy food, or cover medical expenses, or do any of the things that require money in a modern economy. If you are starting to feel that cold dread in your stomach, if you are realizing that the savings you thought were safe in an FDIC-insured bank are actually at risk in ways you never imagined, then you are beginning to understand what I discovered when I started researching this topic and following the trail of policy papers and legal frameworks and international coordination agreements that have been put in place since the 2008 financial crisis. And if you want to know which banks are most vulnerable, which warning signs to watch for that a crisis is imminent, and what specific actions you can take right now to reduce your exposure before the next freeze happens, then subscribe immediately, because what comes next will show you documentation from the banks themselves and the regulators themselves describing scenarios they have planned for. And once you see these documents, you will never feel the same way about keeping large amounts of money in a bank account. The Cyprus bail-in that I mentioned at the beginning was not the first time depositor funds were seized. It was just the first time it happened in a developed Western democracy in the modern era. And the reason it happened in Cyprus rather than somewhere larger is that Cyprus was small enough to be a test case without triggering global panic, and the financial authorities wanted to see how people would react, and whether the legal framework would hold up, and whether they could implement a bail-in without causing riots or bank runs in other countries. And what they learned from Cyprus was that if you do it over a weekend when banks are closed, and if you control the media narrative and present it as a necessary sacrifice to save the economy, and if you implement capital controls that prevent money from leaving the country, then you can confiscate significant amounts of depositor money without triggering the kind of resistance that would make it politically impossible. The protests in Cyprus were relatively small and short-lived. The economy eventually stabilized, and most importantly, from the authorities' perspective, the precedent was set and the legal machinery was tested and proven functional. Within months of the Cyprus bail-in, the European Union adopted the Bank Recovery and Resolution Directive, which codified bail-ins as the standard approach for dealing with failing banks across all member states, and similar provisions were included in the Dodd-Frank Act in the United States through a section that almost nobody has read, which gives the FDIC the authority to impose bail-ins on deposits above the insured amount, and international coordination agreements were signed through the Financial Stability Board to ensure that all major economies would implement compatible frameworks so that depositors could not escape by moving money to different jurisdictions. This was not reactive policy making in response to an unexpected crisis. This was deliberate preparation for a future crisis that policymakers know is coming because the underlying problems from 2008 were never actually solved. They were just papered over with money printing and low interest rates and forbearance policies that allowed banks to pretend their assets were worth more than market value. And now those temporary measures are being unwound because inflation has forced central banks to raise interest rates. And as rates rise, the value of long-term bonds and loans held by banks is falling, and banks are sitting on hundreds of billions of dollars in unrealized losses that do not show up on their balance sheets because of accounting rules that allow them to value assets at historical cost rather than current market value. But these losses become real the moment depositors start withdrawing money and banks are forced to sell assets to raise cash. This is exactly what happened to Silicon Valley Bank in March of 2023. They had invested heavily in long-term treasury bonds when rates were near zero, and when rates rose, those bonds lost 20 to 30% of their value, and when depositors started withdrawing money because of concerns about the bank's financial health, SVB had to sell bonds at a loss to raise cash, and the losses were so large that they wiped out the bank's capital and forced regulators to seize the institution within 48 hours. But here is what should absolutely terrify you. Silicon Valley Bank was not some poorly managed outlier with unique problems. Their balance sheet looked very similar to hundreds of other banks across the country, and the only reason there was not a cascade of failures is that the Federal Reserve and the FDIC stepped in and guaranteed all deposits at SVB and several other failed banks, even though the deposits exceeded the insured limits, essentially creating an unlimited deposit guarantee that prevented runs on other banks. But this guarantee was explicitly described as temporary and specific to that particular crisis, and the authorities made clear that they will not necessarily do the same thing next time because the precedent of unlimited guarantees creates moral hazard and political problems. So the next time a major bank fails, and there will be a next time because the fundamental problems have not been addressed, the authorities may decide to implement bail-ins instead of bailouts. And if you have money in one of these banks, your deposits will be converted to equity, and you will become an involuntary shareholder in an institution that has already failed. The warning signs of an impending crisis are already visible if you know what to look for, and I am going to give you specific indicators that you should be monitoring, because the authorities will not tell you when danger is approaching. They will only tell you after the fact when it is too late to act. First, watch the spread between short-term and long-term interest rates. When short-term rates are higher than long-term rates, this is called an inverted yield curve, and it has preceded every recession and financial crisis for the past 70 years, and we have had an inverted yield curve for much of 2023 and 2024, which tells you that a crisis is approaching, though not exactly when. Second, monitor the Federal Reserve's discount window, which is where banks go to borrow money when they cannot get it from other banks. And if you see the discount window borrowing spike, suddenly that means banks are under stress and cannot access normal funding sources, and this is what happened in the days before Silicon Valley Bank collapsed. Third, watch for sudden changes in deposit insurance assessments. If the FDIC suddenly increases the fees that banks pay for deposit insurance, that means they are expecting higher failure rates and are trying to build up the insurance fund before the crisis hits. Fourth, and most importantly, pay attention to news about bank consolidation and mergers, because when regulators start quietly encouraging mergers between large banks and smaller, troubled banks, this is a sign that they know problems are brewing and are trying to reduce the number of institutions that might fail. But what they are actually doing is making the problem worse by creating even larger, too-big-to-fail institutions that will require even more dramatic intervention when they eventually get into trouble. And when you see multiple warning signs appearing simultaneously, when the yield curve is inverted and discount window borrowing is elevated and the FDIC is raising assessments and banks are merging, that is when you need to take immediate action to reduce your exposure, because the crisis could be weeks or months away, and once it starts, the authorities will move faster than you can react. So what can you actually do to protect yourself? And this is the question everyone asks, and the answer is not satisfying because the system has been designed to make it very difficult to opt out, but there are steps you can take that will reduce your vulnerability even if they cannot eliminate it entirely. First, never keep more than the insured limit of $250,000 in any single bank. And if you have more than that, spread it across multiple banks, making sure that each account is separately insured, and be aware that if you have checking and savings and CDs all at the same bank, they are added together for purposes of the insurance limit. Second, consider keeping some cash outside the banking system. Not a huge amount because cash can be lost or stolen and loses value to inflation, but enough to cover a month or two of expenses in case you lose access to your accounts. And keep this cash somewhere secure like a home safe rather than buried in the backyard or hidden in a mattress where it is more vulnerable. Third, diversify into assets that cannot be seized by banks or frozen by governments, which historically means precious metals like gold and silver that you physically possess rather than holding through an ETF or a bank account, because physical metal cannot be frozen or bailed in and retains value during currency crises, though be aware that governments have confiscated gold in the past through laws like Executive Order 6102 in 1933, so even physical assets are not completely safe. Fourth, reduce your dependence on the banking system by paying down debt and building up alternative sources of liquidity, because if your bank account is frozen, but you still owe a mortgage or car payment or credit card bill, you will be in default and subject to foreclosure or repossession, even though the reason you cannot pay is that the bank has locked you out of your own money. And fifth, understand that the best protection is political, not financial, because none of these individual strategies can work if the government decides to implement comprehensive capital controls or currency restrictions or confiscation programs. And the only way to prevent that is through political action and public awareness that makes it too costly for politicians to implement such measures. This is why I am making this video, and why I need you to share it with everyone you know, because the more people who understand what is being planned and what the legal frameworks authorize and how quickly account freezes can be implemented, the harder it becomes for authorities to actually do it, because they know there will be massive resistance and political consequences. Do you trust that your bank account is safe, that the money you see when you log into online banking is actually there and actually yours, and actually accessible whenever you need it? Or are you starting to realize that deposits are just numbers in a database that can be changed or frozen or confiscated by authorities who face no meaningful consequences for destroying your financial security? And are you prepared for what happens when millions of people simultaneously realize that their money is not safe and try to withdraw it all at once, creating the very bank run that the bail-in system is designed to prevent, but which the existence of the bail-in system ironically makes more likely, because once people understand that deposits can be seized, they have every incentive to withdraw their money before the next crisis. If this has fundamentally changed how you think about banking and deposits and the safety of money in the financial system, if you recognize now that account freezes and bail-ins are not theoretical risks, but planned policies that will be implemented during the next crisis, which may already be beginning, then you need to watch what we reveal in the next episode, because the control mechanisms being built extend far beyond simple account freezes into a comprehensive financial surveillance and control grid that will make today's banking system look free by comparison. Subscribe now, turn on notifications, download your bank statements, and take pictures of your balances so you have proof of what you owned before they freeze it. Talk to your family about emergency plans for how you will access cash and pay bills if accounts are suddenly inaccessible, and share this video with everyone who thinks their deposits are safe, because FDIC insurance will protect them, because that insurance is a promise that cannot be kept when the whole system fails simultaneously, and by the time most people figure this out, it will be too late to take any action except stand in line with millions of others, hoping to get access to money that has already been taken. The next crisis is not a matter of if, but when, and when it comes, the authorities will do exactly what they have prepared to do, which is freeze accounts and implement bail-ins and tell you it was necessary to save the system. And by the time you understand what happened and what you lost, the moment for resistance will have passed, and you will be left trying to rebuild your financial life in an economy where the rules have fundamentally changed and where the concept of property rights in money has been eliminated, in favor of a system where your deposits are just unsecured loans to institutions that can fail and take your money with them, while the people who made the decisions that caused the failures walk away wealthy and untouched and ready to do it all over again the next time their bets go bad.